Welcome to the Goldman School of Public Policy. I am Blas Perez Enriquez. I'm Director of Executive and International Programs and the Center for Environmental Public Policy here at the Goldman School. We're pleased to be able to co-sponsor this event with the Berkeley Institute of the Environment, today represented here by its Executive Director, Sharima Razanai Agam. Also, we'd like to thank the support of the British Consulate in San Francisco, represented here by Consul Annabelle Mullins, and the British Embassy in Washington, represented here by First Secretary on Energy and Environment, David Thomas, from one of the authors of the now famous, interesting, debated Stern Review on Climate Change. Dimitri Zenghelis is a UK government economic advisor who has spent the last year working with Sir Nicholas Stern on the Stern Review on Economics of Climate Change, commissioned by Chancellor Gordon Brown. Dimitri was lead author on the cost of mitigation, model analysis and comparisons, competitiveness impacts, and also the joint lead in disseminating and presenting the review post-publication. As many of you know, the Stern Review's principal conclusion is that the overall cost of climate change are equivalent to losing at least 5% of global GDP. Worst-case scenarios increase this loss to 20%. The cost of taking action can be limited to around 1% of global GDP per year. Since joining Her Majesty's Treasury in 1999, Dimitri has provided economic analysis and advice to the UK government on European and international economic policy. He has been responsible for the internal and published government macroeconomic forecasts using Her Majesty's Treasury model and provided regular briefings to the Chancellor Gordon Brown and Prime Minister Tony Blair. Prior to joining Her Majesty's Treasury, Dimitri has worked as consultant with Oxford Economic Forecasting and the Institute of International Finance in Washington, D.C. on East Asian and Southeast Asia trade and investment flows and macroeconomic policy. He's also worked for Tokai Bank Europe in London. In the early 90s, Dimitri was a senior economic advisor for the Liberal Democrats at the House of Commons in London. He studied at Bristol University and St. Hugh's College, Oxford. Without further ado, Dimitri Zenghelis.
Thank you very much. The phrase "your life jumping before your eyes" springs to mind there. That was a great introduction. Are people happy if can they see better if I do that, or worse? Better, okay. That doesn't mess up the... Okay, good. Well, as you just heard, I'm here to talk you through the Stern Review on the economics of climate change. I won't lie to you, it's quite a long presentation. It's going to be something over 50 minutes or so. This is not because I've been lazy in editing it down. It's because it's the nature of the problem is that it is comprehensive, and it's really not obvious which sections and which aspects of the story I should cut. So to give you the background of this, the Stern Review is an independent review. It was commissioned by the Chancellor of the Exchequer in the UK, and it reports both to the Chancellor and the Prime Minister. And its remit was to assess the evidence and build an understanding on the economics of climate change. It's a comprehensive report. It's a report of 2 halves, 6 parts, 27 chapters, annexes and supporting documents, which can be found on www.sternreview.org.uk. And I'm going to take you through pretty much all of it. So fasten your seatbelts. As I said, it was a report of 2 halves. The first half of the review considers the empirical evidence on the economic impacts of climate change, the approach that we use and the conceptual framework. It then goes on to map the science, the human and environmental impacts. It looks at the kind of stabilization paths we might be wanting to look at to avoid the damages. And then it ends by looking at the costs and benefits of action to reduce greenhouse gas emissions. The second half of the review then considers the very complex policy challenges involved in managing the transition to a global low-carbon economy, creating the right price signals for market action, and spurring technological research. And finally, it ends on the key point of promoting international collective action. I mean, climate change is global in its causes, it's global in its consequences, and global action, therefore, is going to have to be critical in driving an effective and an equitable response on the scale that is required. Okay, so that's the background. Let's take a look at some of the details. That's not the presentation, that's just the introduction. Okay, well, clearly the economics of climate change is driven by the science. It's the science that tells us that greenhouse gas emissions generate damage, okay, an externality. And this externality is global, it's uncertain, it's long-term, and it's potentially very large and irreversible. I won't read out that acronym, but it did sort of spring out, and I couldn't avoid highlighting it. But the key point here is that, that climate change presents a unique challenge for economics. And put very simply, I think it's fair to describe it as the greatest and widest ranging market failure that the world has ever seen. And that's the context in which we examine this issue. And a key point, again, is that no one can predict the consequences of climate change with accuracy or certainty. But we shouldn't be depressed by that, because it's not an excuse for not examining the issue. And we do now know enough to start understanding the risks. And as you'll see, the risks and analysis of the risks plays a very key part of this examination. So let's start with that. What are the risks? And basically what you have here is a sort of cascade of the risks, okay, going through the processes from climate change to the ultimate socioeconomic and environmental impact, which are basically the things we care about. Well, what we have is all sorts of risks. We've got risks in understanding future projections, which are sort of shown by this chart on the top left. We've got risks in understanding how emissions influence atmospheric concentrations, which one example is given here, the example of carbon sinks and the degree to which they might weaken, but also questions such as the degree to which methane might be released, exacerbating the problem. There's uncertainty surrounding all of these issues. You've then got risks in understanding the link from concentrations of greenhouse gases to temperature rises. And in this, we use quite a wide range of estimates for climate sensitivity. And then finally, you've got risks in understanding how these changes in global average temperatures feed through to direct impacts. For example, there are questions such as the degree to which carbon fertilization might offset some of the temperature effects, or the feedback from melting ice sheets or from changing water currents. All of these are subject to a fair degree of uncertainty, and that uncertainty effectively, it fans out, if you like. It builds on each stage of the process. So just to repeat again, risk and the examination of risk just has to be at the heart of this analysis. So let's try and work through this process in more detail, which is effectively what the Stern Review really does. And we start with the key driver of all of this, which is the science. Okay, this first chart shows a summary of the recent evidence of the commitment to warming in terms of average global temperatures, degrees Celsius, for different stabilization levels. I'll come back to what that means in a second. But the important thing to note is that there's new evidence that is built up which allows us to apply probabilities to some of the projections of future climate change on the science side. And that's what these red bars show. They show 90% probability bounds, confidence ranges. So, for example, near the center of the range, you might expect to be the most probable outcome. And these are based on two studies: the IPCC Third Assessment Report in 2001 and the Hadley Center report in 2004. The IPCC, because it's internationally agreed; the Hadley Center, because it's one of the most recent and sophisticated reports in terms of handling these probabilities. However, the grey bars show you a broader range of studies, 11 studies in total. And what you can see is that a lot of the other studies actually show you even greater risks of high temperature increases for given stabilization levels. So if anything, we're being kind of cautious in our assessment of the kind of temperature changes you get. So what do we mean here? Whenever you see parts per million, that refers to concentrations of greenhouse gases, the atmospheric stock. And this story, it's very important to get clear in your minds that we've got stocks and flows. When we talk about annual emissions, the outcomes, if you like, of economic activity, that's a flow into the stock. But what changes temperatures and what causes the damages is the stock. It's these concentrations you have here. And where we are now is somewhere between 400 and 450 parts per million. So this is already ruled out effectively. We might later be talking about stabilization somewhere around here, but I won't preempt our conclusions yet. But the key thing to note is if we carry on as we are, business as usual, we get well below this level here. So what does that mean? If we stabilize at 550, we've got pretty much a 50% chance of keeping temperature changes below 3 degrees centigrade on average. Bear in mind that is average. Some parts of the world will heat up much more. In fact, the global average hides the fact that oceans tend to heat up less because water is a worse conductor of heat on the surface than land is. And so the kind of places where people do live, on the assumption that people don't live in the middle of oceans, will be hit by much higher temperature increases than that. So this masks the regional impact. And business as usual gets us to something far worse than 750 parts per million, which gives us a very strong chance of exceeding the kinds of temperatures at the right-hand side of this scale, 4 or 5 degrees Celsius. So I'm going to come back to what we project might be likely to happen if we don't try and avoid business as usual. But the important then, the next step in that flow that you saw before is to look at what these temperature possibilities actually map onto in terms of the damages that we're interested in. So let's quickly turn to look at that. Now, I apologize about this chart. It's a rather busy chart, and I'm not going to be able to take you through the details, but it just takes this same scale in terms of temperatures from naught. These are all quoted, incidentally, relative to pre-industrial levels. We've already seen about 0.7 or so degrees Celsius rise, and as you can see, these are the kind of ranges that we might get. And the chart shows the kind of projected impacts of climate change associated with these temperature increases that we saw might result from the kind of concentrations that were shown in the previous chart. And this is aggregated across a whole range of sectors shown along the vertical axis. The darkening shade just shows increasing risk and intensity as the impacts of impact as the temperatures rise. And it gives you a sense of an early sense of the convexity of the damages, by which I mean, and I'll come back to this in more detail later, that as temperatures rise, the damages tend to rise more than proportionately with the increase in the temperatures, okay? And we'll come back to that. But for example, what does it mean? We've already got to 0.7 degrees, as I've said already. It doesn't take much, for example, for, for the coral reefs, the world's coral reefs, to be extensively damaged or possibly disappear altogether. We're in that kind of world pretty much already. But a lot of the human and environmental impacts are rather more serious than that. And business as usual, as we saw before, gives us a very serious risk that we might end up in this kind of world here. What does that mean when it comes to the impacts? Well, we're talking about impacts to both developed and developing countries. Developing countries are especially vulnerable. They're likely to see rising water stress, falling farm incomes. They're much more agriculturally sensitive, as that forms a greater part of developing world production. They're more prone to malnutrition and disease, as well as pressures on migration and conflict. But developed countries are not immune either. We're likely to see water stress in places such as California, also places such as southern Europe. Those areas that are subtropical might slip into zones more traditionally arid. And there are going to be costs of extreme events, and that doesn't just mean hurricanes, it also means floods and heat waves, and by nature these tend to be very difficult to predict. And more volatility in itself will imply higher costs of insurance and implications for capital markets. So, for example, if we talk about 3-degree temperature, let's just maybe flip back to this one. If we're talking about a 3-degree temperature rise, okay, we saw that maybe stabilization at around 550 or more will give us a 50-50 chance of a 3-degree temperature rise. What does that map to? Well, it maps to, and you can express this in terms of all sorts of these impact definitions. It might imply, for example, up to 60% more people at risk of hunger, mostly in Africa and Western Asia, assuming weak carbon fertilization. It might imply in terms of water that more than 1 billion people suffer from water shortages. Again, Africa is likely to be particularly hit towards the end of the century. 20 to 50% of species might face extinction, so quite severe impacts on ecosystems. A rise in extreme weather events. We talked about droughts in Europe and California. These could occur as regularly as every 10 years. And possibly rather abrupt and major events in terms of the onset of irreversible impacts, such as the melting of the Greenland ice sheet and also West Antarctica. So it's these disaggregated impacts which are the key story, okay? These really tell us that we should be alarmed, and these already give you a sense of what the conclusions are likely to tell us. But we might also want to model some of these magnitudes on an aggregate level, and indeed there's a lot of pressure to do that, so you can compare like for like and you compare costs with damages. So the next set of slides are going to talk us through this question of whether we can pin large-scale aggregate numbers on some of these changes and how we might go about doing that. Okay, this chart shows a matrix of modeling studies by, I think it was first introduced by Watkis and Downing and others. And effectively, the vertical axis gives you uncertainty in terms of the outcomes, the kind of things we saw before. You know, we can pretty much predict some of the small temperature changes, but and some of the sea level rises perhaps, but it's very difficult to sort of predict the thresholds when ice sheets are going to melt, whether oceanic circulations collapse. And along the horizontal axis, we've got another layer of uncertainty, but this time in terms of uncertainty in the measurement. It's quite easy to measure market impacts. We know how much it costs to build a levee. We know what the impact might be of certain temperature changes to agricultural output, perhaps. Much harder to measure the more socially contingent or environmental impacts, such as political, social stress, and also impacts on human health and ethical impacts. But that shouldn't stop us trying, and that's the key point here. We want to measure as many of these impacts as we can, even though they are surrounded by uncertainty. Okay? We want to move towards the bottom right-hand corner here. We also want to take on the more recent science, and the more recent science suggests that temperature increases could well be in the range 5 degrees or so under business as usual. And it's at those ranges that you get these thresholds that are very difficult to predict, these irreversibilities. But we need to enter them into our calculus, otherwise we're not doing the job properly. Okay, and that's a key part of this story. In essence, I mean, you can sum it up. We want to measure what counts rather than do what a lot of the earlier studies did, which is count what they can measure. In other words, stick to the easy part of the story. Models that tell you that with 2 or even 5 degree temperature changes result in a 2% of GDP impact just don't cut it. They're only measuring the fact that you're going to have to spend more on air conditioning and build a few more levees. They're not looking at some of the environmental, social, political impact, the impacts of pests, diseases, and some of the consequences on human health. And if they're not doing that, they're not really addressing the question to its full entirety. So the point here is we need to grapple with these quite hard to deal with issues. And we also need to include the very aversion to risk that we have in our outcomes. We want to include the fact that we just don't like the possibility of these catastrophic or near-catastrophic events in our calculus. So I'll come back to that. But this is the key point here. Models only have partial coverage of the impact, and a lot of the values that you see in the literature from the earlier work are really just sum totals of the full impact. And we wanted to get as close as possible, and this is one of the reasons why our numbers are higher than some of the earlier studies. We want to get as close as possible to an estimate of this fuller total. So how do we go about doing this? Now, I said fasten your seatbelts before. This is perhaps one of the most tricky charts, so bear with me as long as you can. It will ease off a little bit. But this is one way we went about trying to calculate these aggregate numbers. We saw the disaggregated impacts, but how can we present these, if you like, as close to a single number? Now, I'm going to preface anything I say here by pointing out that I've been in the forecasting game for a long time, and macroeconomics is something that's very difficult to forecast over a kind of horizon of 2 to 3 years. Here we're projecting 50, 100, many hundreds of years ahead. So all of these aggregate projections should really be treated with great circumspection. You've got to treat any numbers we come out with a pinch of salt, and we acknowledge that. And what we want to do is produce numbers that are open to sensitivity analysis, that allow people to say, well, okay, look, we don't believe in this damage function, we don't believe in that discount rate, what kind of outcomes could we get? So we wanted to keep it relatively simple and transparent. That said, I hope this chart will make sense, because underneath it all, it is really quite simple, what we tried to do. There's no smoke and mirrors going on here. The review used the results of one particular model, the Page 2002 model, and this is precisely because it was one of the few models that did allow us to analyze the risks explicitly. And the method we used to illustrate these impacts and account for these risks was to try and express the likely welfare loss, which is what we ultimately want to know about, from these aggregate impacts in terms of what we call the balanced growth equivalent. Okay, so what is this balanced growth equivalent? It's the source, if you like, of those 5 to 20% consumption impacts that were mentioned in the introduction and were quoted quite generally in papers across the world. How does that calculation work? Well, let me try and explain. This is in logs. The black line shows what consumption does in a world that grows happily in the absence of any climate change. It's just not a problem. The green lines show what the world might do. This is clearly running out. Oh, no, there it is. I'm just not pressing it hard enough. The green lines show you a world of consumption in the presence of climate change and climate change damages. Now, we don't know what the exact profile is going to be. There's a lot of uncertainty. We've said that already. So I've tried to express that here visually through this sort of fan of possible paths. And so what we want to do is translate this consumption outcome into expected utility, okay, under the standard assumption, and it's one of the few assumptions we make. So again, it's transparent. People play around with it. Indeed, we have. We've put sensitivity analysis on the web. The standard assumption of diminishing marginal utility of consumption. That simply means that if you get twice as rich, you don't get twice as happy, and social welfare doesn't double. All right? We know that someone who earns $1 a day is going to find another dollar a lot more rewarding in terms of welfare than someone who earns $1 million a day. It's simply that. And diminishing marginal utility of consumption yields two results. Firstly, it means that that future people, because they're richer, are going to have some kind of discount factor in terms of mapping consumption into welfare. And it also means that you get implicitly, you can model risk aversity, okay? Again, if you're offered a fair bet and you could earn $100, and someone says there's a 50-50 chance you could earn $50 or $150, your loss of welfare is going to be higher in moving to $50 than it will be than the proportionate gain of moving to $150. Okay, that's because of diminishing marginal utility of each dollar. And that's risk aversion. That's why we pay insurance very often. And in some senses, this is an insurance story. We think there might be catastrophic consequences on a global level, and we might be willing to pay or do something in order to forego those risks. So essentially what we do is in mapping this to utilities, we take the present discounted value of the expected utility loss, if you like, the integral under all these paths, map them into welfare, and spread it proportionally across all the generations. So we express it as a constant proportion of consumption now and forever. In logs, effectively, we just find another intercept, keeping the growth rate unchanged. Okay, it's a little bit fiddly, but that's all it is. It just takes the utility integral and spreads it evenly across the generations. So that was effectively our approach. What kind of results did we get as a result of this? Well, hey, this is exactly the same matrix I showed before. We've got market impacts and broader impacts along the horizontal axis. We've got some of the climate sensitivities, baseline and high climate sensitivities, which allow for some of these thresholds and potential catastrophic events. And I said before, we want to get as close as possible to accounting for these uncertain aspects. And we ended up with this sort of 5 to 14% range. The 20% range just adds regional equity weighting. Again, this diminishing marginal utility of money. Given that some of the poorer regions of the world are going to be hit hardest, the utility impact is going to be slightly higher than the aggregate numbers tell you. I haven't shown this here because we didn't explicitly model it, but we tried to use previous studies to try and assess the impact of that. And so we think the bottom right-hand quadrant is pretty much the most realistic, and it also embodies the latest science and accounts for the uncertainties, which is why we get slightly higher numbers than we had before. Now remember, I'm just going to emphasize this because you can't emphasize it enough. These models are predicting over very long-term long time horizons. They simply cannot provide accurate forecasts, okay? And they also disguise regional impacts, like I mentioned before. This is an aggregate number. So they're a very sort of broad brush indication of the kind of impacts we're talking about. But I guess as a sort of sniff test, the key question you want to ask is, do these numbers reflect the disaggregate impacts that we saw previously in some of those charts? And I think yes. Essentially, they do map with what you might intuitively feel to be the possibility of very high temperatures and very high damages under a business-as-usual scenario. I mean, to put it into perspective, we are currently about 5 or so degrees Celsius warmer than we were in the previous ice age. So what would you expect to happen to the Earth if you had another 5 degrees added to that? Well, it would simply be very kind of, it would be somewhat surprising if you didn't expect very large changes to both physical and human geography on the planet. It would simply be inconceivable that another 5 degrees wouldn't carry, or at least have a risk of carrying, very high costs. So these numbers seem large, but they're not outlandish. However, one assumption that underlay these numbers was discounting, and how we discounted consumption well into the future. Now, this is just part of the story, but if you think these are pessimistic, then do come back to us. But how do we go about discounting? Well, we use a very, very simple, very, very simple approach to discounting. In our balanced growth equivalent numbers, we tried to measure welfare in terms of today's valuation, accounting for the diminishing, as I said before, marginal utility of consumption. Now, I've already mentioned that we discount because people are likely to be richer in the future, so the higher growth is, the higher the discount rate's likely to be. But we also need to consider whether the future should be discounted simply because it is the future. Oops. There we go. It's another catastrophe avoided. In economic terms, this is known as the pure rate of time preference. And that's what's shown on this chart. And we argue in line with a lot of illustrious economists, including Ramsey, Sen, Pigou, Solow, Nick's very happy to list the whole gamut, that the welfare of future generations over very long time periods should really be treated on a par of our own, and that anything else strikes us as being somewhat subjective and arbitrary. So in other words, we treat these long-term impacts very differently to the way we treat private projects or even public projects. So it's a whole different discount rate that we use here. Now, you can quibble with that and you can change it. You might decide that someone who lives 200 years, their lives are in some sense less valuable than yours now, and you can do that spatially as well. But we don't do that. In this sense, we're talking about, we're trying to avoid notions of the selfishness of the current generation from playing a role in the determination of the numbers that we present here in the damages. So this means the only justification for any positive pure rate of time preference is the possibility that the human race will just be snuffed out altogether. And we assume a pure rate of time preference of about 0.1. Okay? That means that we've only got really a sort of 1 in 10 chance of seeing it out to the end of the century. If you think that's too pessimistic, you'll want an even lower pure rate of time preference, and this gives you an idea of how sensitive that is to higher pure rate of time preferences here. And so the discount rate we use in the modeling exercise is simply the sum of these two elements. In fact, if your marginal, and I won't bore you with the details, but if your marginal, this eta here, if your marginal utility with respect to consumption is equal to -1, which we think is plausible, both empirically and theoretically, then the discount rate is really the sum of the growth rate plus this delta here, the pure time discount rate. The key point to note here is it's the non-marginal stochastic nature of the problem. That means we just can't use the standard tools of cost-benefit analysis. We can't take the discount rate or the growth rate as being exogenous. They're fully endogenous to the model. So we don't use a single discount rate. That's one of the questions we're always asked. What discount rate do you do? The discount rate is endogenous. These are non-marginal changes. Right. So we've looked at some of the damages, and they're pretty nasty. Well, what can we do about it? Well, let's go back to this question of concentrations of greenhouse gases. This blue line is where we're headed under business as usual if we do absolutely nothing at all. And these are emissions now, okay? This is key. These are annual emissions into the stock. In order for the stock not to grow, you want to get emissions down below 10. Okay? 10 is the Earth's natural capacity to absorb greenhouse gases. Anything above that and the stock is still growing. These paths do lead to eventual stabilization. This one, clearly, business as usual, does not. And we've seen the damages associated with business as usual. We're currently already above 425 parts per million in terms of CO2 equivalent. That's rising at a rate of about 2 to 2.5 a year. So we'll pretty much reach under business as usual, 450 within the next 10 years. 550 we'll probably get to by around the sort of 2030, 2040 period, and so on and so forth, with no sign of stabilization. Now, we saw already that there's a lot of riskiness associated with 550 parts per million. We saw already there's a 50-50 chance that temperatures under the latest scientific findings might exceed 3 degrees Celsius, under 550. So 550 you might think is a relatively nasty place to be, and in some senses it is a nasty place to be. But in order to get to 550, you'd need the kind of stabilization path you need to look at would be something along the lines of a peak in emissions in 2020, and then emissions coming down at a rate of about 1 to 2.5% a year. If you wanted to go for 450, you'd actually have to peak pretty quickly within the next few years, and then emissions would have to fall by 6 to 10% a year. You're beginning to get a sense now that 450 is pretty much out of the question. It's just too ambitious to try and achieve that brown profile that you see there. Okay? But we might just still be able to achieve the yellow profile associated with 550. But a key point here, and it's a key point again about the stock flow nature of the problem, is that for every year that we delay, the harder it will become to meet these stabilization paths. As I said, we've already probably missed 450. If we wait that much longer, we're going to probably miss 550. But 550 is well within the feasible range at the moment, as we're going to see. Okay, so we've laid out some mitigation paths. What are the costs associated with these paths? There are 4 ways to cut emissions, and all four routes play a role. You can reduce demand. You can improve efficiency for any given amount of demand. You can lower carbon intensity for any given amount of demand and efficiency. Or you can concentrate on, and this is within the energy sector, or you can concentrate on non-energy emissions. And it's worth taking a look at that for a second, because you can see that in non-energy emissions, at present at least, land use is actually bigger than transport. And so curbing deforestation is likely to be, and is indeed, in many senses, very cost-effective and relatively cheap to do. And it's something that can often be forgotten. And I'm not going to talk about it much in this presentation, but it is in the review. So it's not just all about energy. It's not all about transport. Okay, so how do we go about estimating the costs of meeting certain stabilization paths? Well, one approach we took was just simply to look at the main modeling exercises. There's a lot of them out there. And these are rich models. They're very complex. They allow for full specification of behavioral responses amongst producers and consumers. So that's their advantage, that they're pretty comprehensive and they're pretty detailed, but it's also their disadvantage. They're very complex. The devil's in the detail. What you get out of them depends on the parameters you put in. Excuse me. So we commissioned a meta-analysis of these keys, or a number of these key studies, in order to try and pin down which of the parameters and which of the assumptions are significant. And when we do that, and when we look at the broader range of studies that are out there, we found that for a stabilization of around 550 parts per million, a plausible cost by mid-century is about 1% of GDP, plus or minus, and this is the catch, about 3% either way. Now, that might not seem very, it'd be nice to pinpoint, but there are uncertainties relating to technologies, relating to a number of factors on the cost side. But even with that margin of error, we'll be able to compare that later on to some of the damages. The second approach we took was to use resource costs. Now, this is much simpler and much more transparent, which is, in essence, its key advantage. It simply and intuitively takes the cost of technologies required to decarbonize the economy, or in the case of the study we looked at, decarbonize the energy sector. This doesn't take any account of behavioral responses. It allows for no attempts by consumers or producers to try and increase efficiency endogenously. So in that sense, it can be thought of, at least theoretically, as an upper limit on the costs. The resource cost approach essentially requires an assessment of current and future technology costs. Now, this chart, purely illustrative, I sort of made it up myself, but it shows a kind of plausible array of technologies expressed in terms of the marginal cost of a reduction of greenhouse gases. You could envisage hydrogen vehicles. It's still very nascent technology, expensive stuff. So it's expensive to reduce each unit of greenhouse gases. Whereas energy efficiency, by definition, it's a kind of a free lunch. You can reduce greenhouse gases and save costs on your fuel bills and save resources. Deforestation might be quite cheap. And you see a kind of continuum, right? It's illustrative. But the point is that this profile starts to move down, in particular for the more technologically complex aspects as technologies improve. So hydrogen in vehicles might become cheaper. They might also become cheaper than some. Yeah, whatever. You get the idea, okay? And that underlies this attempt to try and assess the evolution of technologies. It plays a key part in our resource cost approach. So what determines where we want to be on that particular curve? Well, the answer is shown on the left. It's the social cost of carbon. Social cost of carbon is likely to increase over time. Why? Because the marginal damages from the greenhouse gas stock increase. We said before these are convex. So as the greenhouse gas stock increases, each additional emission is going to cause more damage. So that's an upwardly rising profile. Because greenhouse gas stocks rise through time, we expect the social cost of carbon to rise through time. So policy should therefore ensure, if it's efficient, that abatement efforts on the margin also rise in line, the cost of abatement efforts also rise in line with the social cost of carbon. But again, as technologies improve, as we saw before, the marginal abatement curves will start to shift to the right. And this is the chart that we look at here. It's the same chart. It's the right-hand chart that you saw before. It basically, again, shows marginal costs. Well, it shows costs per unit of emissions. And this may be where we are now. The marginal cost is, for any given technology, is the cost at the sort of on the very last and most expensive project you undertake. That's going to correspond with the social cost of carbon. The average cost, of course, is going to be below that because you'll have a whole load of cheaper opportunities that you might want to undertake. And the point here is that as technologies improve, consumers may actually see falls in prices, even though the social cost of carbon increases, and correspondingly, the marginal project becomes more expensive. Why? Because the average abatement curve starts to shift down. It may not fall, the average costs may not fall, they may be flat, they may rise, but they may not rise as quickly as the social cost of carbon. And so therefore, costs to consumers may not rise as quickly as the social cost of carbon, which is a key point. Technology drives down average costs, and in particular, the very action of trying to increase mitigation activities will induce technologies that drive down the cost of action. So there's a sort of a virtuous circle there. So how do we estimate these resource costs? Well, we took a very broad and illustrative array of technologies, current and future technologies, and we tried to suggest a kind of portfolio that would correspond with the sorts of mitigation emissions reductions that would be necessary to meet a 550 parts per million stabilization target. Again, these are very illustrative portfolio of technologies. Why a broad illustrative portfolio? Because all technologies are subject to constraints of some kind. The best sites for wind turbines or solar panels will begin to run out. You'll run out of nuclear scientists, etc. So costs on the margin tend to increase. So we spread the burden across an array of technologies. And also, we just don't know. It's uncertain which technologies will turn out to be the cheapest. So we're just assuming that the burden of emissions reduction is spread across all of them. Note also the importance of carbon capture and storage. This is for mid-century. This one here, if you can't see at the back, is 2025, 2050. And we can see that carbon capture and storage really does have to play an important role in this. Why? Because many countries still do sit on stocks of hydrocarbons which can be extracted at very low marginal costs. There's more than enough cheap coal, lignite, oil, and even gas to take the world to greenhouse gas concentrations of 750 parts per million or more, with all the associated damage. So part of the story's got to involve fossil fuels continuing to be used, but carbon capture and storage. But again, that shows the uncertainty, because carbon capture and storage is still a very new technology. Okay. Back to our results. Effectively, this line here corresponds with this line here. It shows the average cost of abatement, and I said before that that might fall. The study conducted by Dennis Anderson, who's an expert in energy technologies, suggested that the average cost would fall even as costs on the margin increase. And so we effectively multiplied, and this is how simple this approach is, it really is. We multiply the average cost, the weighted average cost, weighted by mitigation contribution of these technologies, by the amount of abatement required to meet a 550 stabilization target. One times the other gives you the total cost of abatement. So that by 2050, that's equivalent to something like, that's equivalent to something like 930, or kind of approximately $1 trillion per year, which is about 1% of GDP, or plausible GDP in that year. Okay. Again, there's a margin of uncertainty of around more or less 3 percentage points either side, because a lot of these assumptions are going to be very sensitive to the pace of technological innovation and the evolution of fossil fuel costs for the reasons I've already given. But the interesting thing is that this approach really did corroborate. It's a very simple, transparent, and possibly approach that's possibly biased on the upside, kind of corroborated the much more complicated integrated modeling approaches and came up with this sort of 1% of GDP by mid-century. In order to find the appropriate stabilization range, we talk about 450, 550, we wanted to confirm with ourselves that 450 to 550 was the right range to aim for. That seems to be where we were headed. And what we did, and one way we tried to do this, was to compare the marginal costs of abatement with the social costs of carbon, a very sort of traditional microeconomic approach, if you like. Business as usual would take us out here. This is stabilization targets. So, you could think 450, 550, et cetera, et cetera. So we start on the right-hand side in a world where we do nothing and we move towards a stabilization target. And looking at all the models and impacts of costs, we found that on current evidence, a feasible stabilization range would be around 450 to 550. The reason why there are two sets of each chart is not because you're seeing double. It's because there is innate uncertainty. We just don't know where the precise schedules lie. But as I'll argue later, uncertainty is a reason for more rather than less action. And we found that starting in this range, anything higher in terms of a stabilization target, in other words, as we move to the right, would substantially increase the costs of very harmful, the risks of very damaging impacts, while reducing the expected cost by comparatively little. So it suggests you want to be to the left of that. Anything below 450 and to the left of 450 had the reverse effect, if you like. Okay, it imposed very serious adjustment costs for rather small gains in terms of marginal damages. So we talked about the convexity in the damages. There's also a degree of convexity in the costs. Most of the models show that if you move from around 500 to 450 parts per million, costs could possibly as much as double on the margin. Okay, so that's how we kind of used this to corroborate our view that we thought that we should aim for something like 450, which is a very nice place to be in terms of damages, but really quite costly to get to, and 550, which is a kind of becoming a nasty place to be in terms of damages, but is still attainable. And the other aspect that comes out of this, of course, is, as I've mentioned before, that if we don't move fast, these schedules are going to start moving out to the right, because we'll find it we've already missed the chance effectively to stabilize at 450. If we wait another 10 years, it's probably going to put 550 out of reach, because we'll be facing this very high cost profile associated with stabilizing at 550. So the speed of action is very important. The first half of the review, you'll be pleased to hear, not the first half of this presentation, we're more than 3/4 of the way through, but the first half of the review looked at the empirical evidence and demonstrated that strong action on climate change, including both mitigation and also adaptation, though I've not really had a chance to talk about it yet, are worthwhile, and suggest that the appropriate goals for where the appropriate goals for climate change policy might be. The second half of this review examines the appropriate form of such a policy framework and how it can be placed within the context of international collective action. Okay, so that's what I'm going to turn to now. I mentioned at the very beginning that this is a global problem and international collective action is going to be key. There's a lot of obvious game theory in international collective action. So much of this story here is going to be about building trust, okay? Going to be about building a sense of shared awareness of what the problem is. And along the way, we're going to have to require understanding, transparency, and cooperation in order to get there. And even though international law is arguably a very weak tool for compliance, countries usually do honour international commitments where they conform to shared notions of responsible behaviour. And that's going to be a key part of this story as well. So how are we going to get action on a global scale? Well, it's going to require clarity in terms of what the long-term global stabilization goals are, and that's where this kind of discussion is very important. It's going to require short-term flexibility in the use of market mechanism, including both taxing and trading, and regulation plays a part as well. It's going to involve, efficient mitigation is going to involve a comparable global greenhouse gas price. A ton of carbon does the same damage wherever in the world it comes from, whether it's in Berkeley or Bangalore, it causes the same global damage. And so a global carbon price should reflect that damage. And such a price can be created in many ways, and we need to build on and support national policy and various national mechanisms. International collective action will also require cooperation on technology, and this can take many forms, from coordination of research priorities through to risk sharing on large demonstration projects and agreements to address regulatory issues. And finally, well, almost finally, it also requires a fair distribution of efforts on emissions reductions for both developing and developed countries. If policies are thought of as being unfair, it's going to be much harder to get all countries to sign up to them effectively. And that's not so hard. China and India have, for example, very ambitious plans in terms of reducing carbon and energy intensity already. And we need, awareness of some of the co-benefits that come from climate change action plays a key role in that. Those come in the forms of reduced local air pollution, increased energy security in some cases, and improved energy efficiency. So there are very many reasons from a local level why countries might wish to go down the mitigation route, as well as opportunities in green technologies. But perhaps, and perhaps most importantly, in order to get international action on climate change, you really need to action can really only be sustained if you effectively carry public opinion. And that's important in every country. So governments really need to inform, persuade, and educate populations and encourage as much debate as possible. And the US is a good example. It's no coincidence that California is rather ahead of the game in terms of some of these mitigation endeavors, precisely because the political discourse in California is somewhat different to other parts of the country. And that's the same across the world. So let's take a quick moment to look at one cap-and-trade mechanism in particular, and that's currently the largest international trading scheme, the European Emissions Trading Scheme, the EU ETS. And it's made a very important head start in structuring carbon markets. Going forward, we think it's very important that it continues to build on this, learning from some of the early experience of the scheme and creating an outward-looking, deep, but also credible scheme. The EU ETS has already made impacts on the global carbon market outside the European Union. It's linked very sensibly to global mechanisms. Companies and governments can reach targets by investing more cheaply in reductions outside the European Union through use of the Clean Development Mechanism, the CDM, and joint implementation schemes. And this allows for the most efficient avenues in terms of mitigation to be exploited the world over. A key part of keeping costs down is that you're able to exploit the cheapest mitigation options, and very often they don't occur in the countries that tend to be most committed to greenhouse gas reductions. And it provides a neat way of channeling development flows into poorer countries. So the CDM, the Clean Development Mechanism, is a very important part of the story. And CDM market volumes actually doubled, or did they double? No, they grew threefold, I beg your pardon, in a single year between 2005 and 2006, driven primarily by demand from the EU ETS. So it's had problems, but potentially it's going to play a very important part of the picture, especially if we can manage to get the EU ETS linked into other regional schemes, which are already in existence in the US, in Australia and in Japan. And linking the EU ETS to these schemes and using CDM-type international mechanisms is crucial in ensuring that, that global reductions can be made efficiently wherever they occur in the world. And this chart shows just that. For example, if you were to start with where we are now in terms of the ETS, but include all power and heavy industry emissions in the USA, in the EU, in Australia, and in Japan, that would open up a market about 3 times as large as the current EU ETS, and that's this bar here, the third from the right. If you were to go further and to include all the top 20 emitters in the world, you'd actually capture about 80% of global emissions and increase the market size up to 5 times relative to where we are now in the EU ETS. So the mechanisms are already being installed that will allow for a globally coordinated response. I've talked a lot about the social cost of carbon and about pricing the externality correctly, and that's important in inducing greenhouse gas reductions. But another part of the story has to be innovation as well. Actually, we were talking about this on the journey up here. You can price the externality correctly, or you can fund innovation, but if you do one without the other, you're really getting much less of a bang for your buck than if you did both. A carbon price alone won't deliver the necessary reductions in greenhouse gases because there's policy uncertainty over the future carbon price. There's barriers to new technologies and energy markets. In other words, there's an array of market failures on the research and technological development side. So we're going to need a range of technologies in order to achieve stabilization. And many of these are already available, but many we can't be sure about, and many are still in the process of evolution, and we don't know which ones are going to be viable. So technologies at an early stage are going to be subject to the most uncertainty, and they're going to be the ones that are going to require the greatest degree of public support. This chart here, it's subject to a little bit of sample selection because it's an ex post chart of technologies, but it shows the degree to which their costs have fallen through time. Clearly, the less successful technologies will have been junked early on precisely because their costs didn't fall. But it gives you some indication of the degree to which learning by doing and experience is likely to bring down the costs of individual technologies. But investors, individual private investors and capital markets cannot determine this or predict this with confidence. They can't be sure that public policies are going to be supportive into the indefinite future. So market support policies are going to be required, and research and development funding is likely to be required as well to address this additional nature of the externality. Turning very quickly to adaptation. We argue that adaptation is inevitable. Climate change will affect all countries, and so all countries to some degree will have to adapt. Whereas mitigation is a global public good, we all benefit. Adaptation, the benefits will tend to be more local. In addition, there will tend to be limits on what adaptation can actually achieve, as the effects of climate, in particular as the effects of climate change damage intensify. So at some of the more extreme impact levels, as we approach 3, 4, 5 degrees, the usefulness of adaptation is going to diminish on the margin. That applies to significant sea level changes, to some of these unexpected thresholds, which are going to be very difficult to adapt to. And ecosystems, for example, they just can't cope with the rate of change that would be that would occur under those more extreme scenarios. Also, and I think this is very important, unlike mitigation, adaptation just doesn't address the kind of risks and uncertainties that we talked about. Risks and uncertainties are an important part of the picture. We want to avoid climate change because we want to avoid some of these horrific outcomes that they may not, but they may occur. Adaptation, by definition, requires knowing what it is that you're adapting to. So you can't do that in advance. Once again, and it will come as no surprise, the impacts are likely to be felt earliest and strongest in the most vulnerable countries, especially developing countries. However, so the costs of adaptation are going to have to be higher. However, given much higher levels of capital to protect the monetary costs, which maybe don't give a fair indication of welfare or human life costs, but the monetary costs could be much higher in rich countries. But adaptation has another side to it, which is also important to emphasize. Adaptation and development, in essence, go hand in hand. Development itself enhances capacity and flexibility, and honoring existing ODA, overseas development commitments, should provide the funds and the support for adaptation. Indeed, much adaptation of the kind that is suggested will simply be an extension of good development practice. So in that sense, climate change simply increases the case for meeting pledges made in Monterey in 2002 and in Gleneagles in 2005. Adaptation should be integrated into development policy and planning at every level, including donors, multilateral organizations, and development institutions. But it should also be included in terms of funding what we call global public goods, which require going beyond the single country approach. And these include things like centralizing capacity for disaster response, global weather forecasting. Africa is much less extensively covered in terms of monitoring meteorological and climatological developments, and regional centers to both process and disseminate data, including communication networks. Also, overseas development currently does not cover things which are global in their impact, such as sea level rises, migration and political conflict, etc. And there should be some funding of areas designed to cope with that. Okay, so I've talked for kind of just over 45 minutes, and you must all be getting quite exhausted. To conclude, I've taken you through equivalent of 550 pages of this report, and there's some key bits which I'd really like to talk to you about, which I've had to miss out by necessity. But the key story that we get here is that our understanding of the risks of climate change and the science underpinning climate change have come a long way. The science and the understanding of the uncertainties has advanced strongly. We understand the scale, and more especially the urgency of action needed. We've talked about how delaying action is simply going to increase the costs. You're going to have to scrap infrastructure prematurely, whereas if you adjust in a timely manner, the costs are going to be much lower. But also, you're going to miss the chance to stabilize at certain atmospheric concentrations because of the stock flow system, the stock flow nature of this problem. So acting sooner rather than later is important. We know that the technologies and the economic incentives for effective action are available, and where they're not, we know how they can be created. And this is likely to keep the costs of early intervention relatively low. And so we're in a much better position now to use our shared understanding to agree on what the goals are, and what goals to adopt, and what action is necessary to take. Effectively, unless emissions are curbed, and this is our final concluding gambit, climate change will bring high costs for both human development, the environment, and economic progress. We've concluded as a result of all this analysis that concentrations of 500 parts per million and above are likely to incur very high risks of serious economic and environmental and human impacts. Concentrations of 450 parts per million and below just seem untenably difficult to achieve now with the technology that we have available, and are probably inconceivable already. So limiting concentration somewhere within this range is likely to be the most pragmatic way to go forward. And the costs of doing this, we think, are modest. Well, they're certainly modest relative to the cost of not doing it. So the key bottom line there is that not only can you be green and grow, you'd be rather foolish not to be green, because you really won't grow if you're not. And the risks of having some overwhelmingly negative impacts, given what we know about the science and the uncertainties, becomes very large. So where does that leave us in terms of policy action? Well, it suggests that decisive and strong international action is going to be urgent, and that delay is going to mean greater risks and higher costs. And that was the bottom line conclusion of the review. Thanks very much.
Thank you, Dimitri, for a very comprehensive, interesting, and dynamic presentation. I'm afraid this is the time when you face the intellectually curious UC Berkeley community.
Thanks a lot.
So we have some time for Q&A. I'll try to keep some order. Please identify yourself, name and affiliation, please.
Fritjof Capra, Center for Eco-Literacy. I have actually two questions. One is, in your pie chart of stabilization technologies, I didn't see agriculture, meaning the shift from chemical to organic agriculture, which can dramatically increase the carbon of the soil and therefore draw down carbon from the atmosphere. The second question is a request. Could you tell us a little bit about the response you have received in the last month since the publication of the review?
Okay, the first question, yes, you've pointed out an oversight in my presentation. The Dennis Anderson resource cost approach was an approach that looked only at energy. energy in power generation, energy in transport as well. We looked at agriculture separately, but it wasn't part of this approach, so you're right to point that out. The costs increase a little bit if you include multi-gases and land use in terms of carbon dioxide as well. But they don't increase dramatically above that 1%. It takes you into the 1.1, 1.2%. But that's a good point, and I'm thank you for pointing out that I omitted to mention that. The response we've had, in a sense, has been, well, it's been gratifying for one thing, because there has been an extensive response. And what's kind of satisfying as well is that we've really had an even balance of insofar as we've had critical responses, that's been balanced on both sides. We've had criticisms about the fact that our damage function, the exponent on our damage function, is somewhat conservative, so that we really haven't accounted appropriately for some of these thresholds and irreversibilities. A lot of people, or some people, have commented that maybe we should have adopted a more sustainable development type approach, where future generations should inherit a capital stock that allows them to live lives that at least we could live now, and that if we adopted that approach, and the question of irreversibilities would make action imperative. But on the other hand, we've had the usual gamut of comments about the appropriate discount rate, which we think we've made progress actually in. I mean, those comments petered out quite quickly, and a lot of the criticism on that front, I think, abated in line with the responses that we made. We also had comments, fair comments, about how we treated the uncertainties and how we treated this impact, long tail of impact into the future. But again, those comments and those criticisms work on both sides. And on the more positive note, we've had a huge amount of support and a huge amount of positive feedback, and a lot of questions that have come in on the basis of some of the questions we've led up to but haven't been able to answer, just haven't had the time to push the analysis further forward. So that's what we'd like to do. There is on the website an extensive Q&A that we've put up since we've had some of the responses. So you might want to have a look at that to give you an idea of what the key issues were in terms of some of the feedback that we got.
In the back. Yes, Tom Tanasiu from EcoEquity. My question is about your treatment of the 450 scenario. I mean, you've organized your presentation around 550 CO2e, and you've said that it gives you about a 50% chance of reaching 3 degrees centigrade. My understanding of the science is that that's a bit optimistic, that chances are that 550 CO2e would be much worse than that. And I have sort of an unfair question, which is, to what extent is your focus on 550 rather than 450 CO2e the result of a political decision that if you were to talk about an emissions trajectory that was consistent with, say, the most widely accepted precautionary target of a maximum of 2 degrees C, very widespread among scientists, among NGOs, and among Europeans, that would lead to an estimate of the cost of mitigation that would have caused you to have less of a political impact in the short term. Do you understand my question?
Absolutely. Yes, I mean, in terms of whether 3 degrees is plausible or not, I'll slightly cop out of that one on the grounds that I'm not a scientist. We had scientists in the team, but luckily for me, they're not here to answer the question. But yeah, that is a criticism we've heard. I've kind of rolled that into the convexity question. But it's not really, because 3 degrees, 550, those aren't extreme areas. So yes, there have been criticisms that actually, we're underplaying the damages. The only thing I'll say, and it's a little bit of it's a cheeky response, but I'll point this out, and a lot of you probably haven't missed it. We're talking about 450 to 550 as being the optimum, but we still see that in that range, the net costs of action are strongly positive. Okay, 1% of GDP, but we're looking at that sort of stabilization range of saving, 5, 6, 7, 10, 14, whatever the numbers are of that range, percent of GDP. So that says something about the fact that, yes, you could go for a lower stabilization target and you'd still make net gains. But what we found was that the optimum in terms of those net gains, it goes back to this chart here, which I had to rush through a little bit. It's a little bit more complicated than, this is one of the charts I've toyed with taking out. But we do find that and that's why we did this approach, we do find that on the margin, as you get towards 450, the extra marginal reduction in emissions is going to cost more than the marginal damage abated. But that might be premised on the fact that we think 3 degrees. If you take a more pessimistic view of what 550 leads you to, and you think it's more than 50 degrees, then clearly that is going to shift that over. But we did find that the models showed that the costs would rise very steeply. They wouldn't be 1%. They'd very quickly go to 2-3%. So the marginal addition would increase. So in terms of your net savings are going to be highest in this 450 to 550 range. But yes, people have said that actually the damage is, to put it another way, we think that maybe if we're right about the science, we think that actually going for 2 degrees is not going to be the optimal because it's going to be too costly.
Steve Beckendorf, I'm molecular and cell biology. I'm concerned about the carbon trading schemes that you're so optimistic about helping, especially the clean development mechanism. And the way I understand that is that polluters in developed countries can continue to pollute at the same level that they were doing before by getting somebody, generally in an undeveloped country, to do something that doesn't use carbon. And I think it's a shell game because, for example, in Ecuador, people are building hydroelectric plants and saying, this doesn't use carbon. And it'll remove thermoelectric coal and oil-generated power from the grid in Ecuador, and so the industrialized country can get that benefit. But that's not going to happen because the extra power in Ecuador is simply going to increase development in the country. The demand for power will increase, and those oil and gas-generated electricity is going to continue to be used. So all we're doing is increasing or stabilizing the usage of those sources in Ecuador and allowing the polluter in the industrialized country to continue to do what they were doing before. Right. I mean, there's a couple of questions I think wrapped up in that. I mean, you raise. I mean, I'm not an expert on the empirical evidence of how CDM has been used, and I know that there are, as with any such scheme which is relatively new, that there are examples where it's not been applied effectively, and in some cases, counterproductive. So I'm sort of couching this in terms of a CDM that is applied effectively, and that means that the action taken in recipient countries has to be additive. So it has to be mitigation that would not have been undertaken in the absence of the flow. It can't just be, we're going to relabel mitigation we would have done anyway, and let's get the money for it. I'm particularly concerned about the focus on shifting the blame to the developing countries and not doing it in the industrialized countries, where the reduction in pollution would really make a bigger difference.
Right. Well, you'd pay for it in the industrialized countries. And in a sense, if paying for it increases the development in those countries and increases the demand for emissions in those countries, you've actually done something which is, it's by definition, has to be a pretty good piece of development aid. If they become so much richer that calls for. But then that means that you're back to square one. Then you have to tighten your window. And done well, that means that again, it's going to be the rich countries that have to pay a little bit more. So done well, and I have to couch this in terms of the efficient way of doing it, you actually have powerful development flows into those countries, but you do so in a way that allows you to meet your targets, which requires a lot of distribution of flows from the developed to the developing world. Now, it's true if you're finding that this mechanism isn't allowing you to meet your global targets, and that just says you've got to tighten the targets. And that's got to be you've got to do whatever it takes to meet those targets. And if these flows are making it harder, then that's just another way of saying they're not tight enough.
Turning on in regards to social and ethical dimensions of climate change. I just reiterate the point that I think Tom from Eco-Equity made, which is about my first question. It does seem to me that the best science today indicates that surpassing 2 degrees Celsius increase or 450 parts per million could lead to really catastrophic losses. For example, in your chart, you do mention the possibility of coral reef collapse, Amazon forest collapse, and recent soil science sort of reinforcing those worries. So just building on that, I question, given that if we do have to shift our concerns to the left on the chart, such assumptions as, given that there's lots of still relatively cheap oil, coal, lignite, etc., that it should be used. I mean, if we do have to increase our concern, then maybe that assumption about the use of existing cheaper resources would have to be reduced just to some extent.
I mean, that's a very good question. I mean, if we operated with adaptive expectations, we would spot the fact that the science is constantly squashing this chart to the left, like you said, and we would try and predict the fact that, when we started this review, we would have to factor in where we'd probably be in a year's time. And it may well be the case that we're already a little bit out of date on the science. We're a year out of date, and it's probably on past precedent. I just don't know. I'm willing to take that as fair comment, and some of the feedback we've had suggests that that may be the case. So the impacts could be rather worse than we've given here. The question about fossil fuels, I'm rather better equipped to handle as an economist. I mean, the problem is that a lot of these fuels, take oil, for example, a lot of the oil in the Middle East is extracted at very low marginal cost. Okay? It's not reflected in the oil price. The oil price is much higher than the marginal cost of extracting them, so in other words, a lot of countries just obtain pure rent. And that's a function of relatively oligopolistic supply amongst the major suppliers. The problem is that in such an environment, you can actually start pricing carbon quite highly, and all that's going to happen is that the price to the supplier falls. But it's still not going to fall. It's going to take a very long time until it falls to the point where it's actually not productive, not efficient for them to extract the stuff. So it will be extracted at whatever cost. They'll get less rent, and they'll certainly those countries affected will make a big noise about this, but they'll still pump the stuff out. And we've got.
Not the expensive and polluting shale.
Yeah, there will still be a supply curve, and on the market, there will be some of these, more expensive shales and tars and deposits that will only be extracted at high cost, and some of the deeper extraction North Sea wells. And I'm not an expert on but you can see that there will be certain, there'll certainly be reductions. There is a supply curve there, but you would have to impose quite high prices in order to get rid of all the low-cost. Effectively, what I'm saying is the market is distorted. The oil prices and fossil fuel prices are rather higher than they would be in a free market, and we'd actually be burning even more fossil fuels at a higher pace than we would be in the absence of those market failures.
Market distortion, how we got there in the first place?
Well, it would be even worse if it wasn't for the market distortion in some senses. We have OPEC to thank for not talking about even higher greenhouse gas stocks. So, but that's why carbon capture and sequestration has to play a role. But there's a lot of uncertainties around that particular technology. But we've really got to take a serious look at how we encourage that technology.
My question, I suppose, is partly related to market distortion. You talk about uncertainties, but it seemed in the presentation most of the uncertainties you were focusing on were the uncertainties of these impacts. And I wondered, it may be more difficult to factor the uncertainties of economics, because I'm not an economist, so this is not my expertise, but I think there's certain features of the economy today that weren't necessarily predicted, like the extent of very cheap goods. So I wonder what level of economic uncertainties you factored, because it seems very, very much based on uncertainty of a lot of other things, but certainty regarding the economics.
Should we collect questions, or are you happy for me to?
We have less than 10 minutes. Well, 10 minutes, so we can do groups of 3. Why don't we them in order. So.
Dave Thomas from the British Embassy. It's not actually a question, it's more of a supplementary answer for this gentleman on the question you asked, which was how can we get developed countries to actually take their share of the burden? I wanted to talk about the phase 2 of the EU ETS, where in phase 1 we did see a lot of liberty where companies could offset their emissions through the CDM in developing countries. But in phase 2, governments are going to be tightening the caps they place on their industries, so they must they must abate their own carbon within country. So that's one, I think, answer. The second is trading, of course, is one of a range of issues. In the UK, we have something called the Climate Change Levy, which encourages business, if they want to get an 80% discount on this levy, they can make themselves more energy efficient by reducing their own carbon footprint, which again forces action within the country. And secondly, I think it's the education point, which is we have something called the Carbon Trust, which goes out to businesses and into the private sector and shows how we can make big companies much more energy efficient and thus again reducing their carbon footprint. Thanks.
Hi, my name is Leslie Martin. I'm a grad student here. When you showed the different graphs comparing the costs and benefits of mitigation, of course, I appreciate the fact that it was done from the point of view of a global citizen. But as we all know, the whole problem with climate change policy is that the benefits and the costs accrue to very different groups, and you mentioned that several times. Absolutely. Did you ever consider, when you were doing the analysis, doing it specifically for UK citizens, for instance, and coming up with the numbers? And if so, what types of costs of abatement did you see with that?
Good question. Yep.
Kevin Sweeney, I'm a consultant and I teach in the business school. I have a question. Do you have any lessons for us or insight on how to talk about these issues? You at 2 to 3 degrees, you're describing a different planet. And then you're saying we have to act in 10 years or we're going to have a different planet. So, roughly at that time period. So there are a lot of people in the U.S. who thought we had the luxury of time and we don't. And really we're looking at kind of biblical plagues if we don't act. So you have this fan of people with the team that is out actually proselytizing all over the U.S. and in other countries, which I think is fantastic that you guys, it's not a report on a shelf, you guys are out pushing it. Are you learning stuff about how to talk about this? What do you hit stupefied reactions from people? How do you break through and communicate on this issue?
3 excellent questions. I'll take them each, I think, in turn. On the uncertainty in economics, you're absolutely right. There's a lot of uncertainty in economics. I think it's fair to say that most of that uncertainty is on the mitigation side, the economic uncertainty, for the simple reason that it's dwarfed by all of this on the impact side. I mean, economic innovations and the nature of markets just can't compete with large-scale shifts in the climate system. So it forms a small part of the damages. But it forms a relatively large part of the mitigation story. And when we talk about this 1% of GDP being bounded with this sort of plus or minus 3%, and that's quite a large, that's everything from net gains to really quite large costs. And that is effective. I mean, it depends how you define it. But, a lot of, those are economic assumptions in there. In particular, the rate at which technological innovation changes the world, but all sorts of things go in there, including the kind of the flexibility of policy action, the degree of co-benefits that you factor in. I mentioned things like reducing pollution, energy security, etc. There's a number of factors that are brought in to determine those uncertainties, and I think most of them more or less can be termed economics. I think you're absolutely economic, so I think you're absolutely right. But we still think that those costs are relatively small relative to the damages. The question about whoever made the point about regional impacts, absolutely crucial, and I didn't have a chance to emphasize it. It's one of the real problems about talking about these aggregated numbers, that you really miss a big part of the story, which is that some places get hit hard and some places don't get hit at all. In the early years, actually, large swathes of the more temperate or northern continental areas probably did quite well. Siberian agricultural produce is going to benefit significantly, and there are Scottish wine producers that are rubbing their hands. But that masks a lot of quite serious impacts in other parts of the world, in particular the more vulnerable parts of the world. We did First of all, I should emphasize the Stern Review was deliberately supposed to be international. It didn't want to talk about specific policies for specific countries or specific sectors. It hinted towards what we thought are the appropriate policies and how we could get an international collective response. But it didn't talk about, it didn't want to go into detail. And for that reason, we were quite keen to avoid making it UK-centric. However, we were in the UK, we did have access to UK data, and in particular on this issue of competitiveness and the competitiveness impact, we did look at the UK, and we wanted to look at the risks of certain carbon and energy intensive firms moving out of the UK. The reason we chose the UK is because we had, as I say, disaggregated UK data at our fingertips, and one of the exercises I did, which in the review we strongly recommend that other countries undertake similar exercises, is to look at just how vulnerable tradable carbon-intensive sectors are in their economies. And we used input-output tables to feed through some illustrative change in energy costs from coal, oil, and gas with the corresponding carbon intensity through the UK economy, and which industries would be hit, what cost increases would they see, and how tradable are they. And it was interesting to find that actually a lot of the most sensitive sectors were actually not particularly tradable, in the UK anyway. Gas distribution, electricity production, coal, for example. Whereas some of the more tradable sectors, they tended to be lower down the list, but insofar as they were tradable, they also had comparative advantages in terms of a whole host of other areas. And there's a section, chapter, I should know because I wrote it, chapter 10, I think, in the report goes through that. And then there was the question about what we've learnt about how we communicate this and the level of discourse, and that's a great question. And it links, I think, to some extent to the point made before about the politics and to what extent we are, we were political in our findings. I mean, the answer is we weren't trying to be political in our findings, but we were keen to show that if there are costs, and there are costs of doing something, that they're fairly represented. And we were keen not to make policy recommendations that knocked us out of the running in terms of having the ear of important parties. If this is a problem of global collective action, and if we are arguing that this has to be addressed with a common shared notion of what the likely magnitude of the issues, we want to allow all countries and all sectors to have the possibility of gaining something out of this. And in theory, everyone can gain something out of it, and there is a bargainable solution that is a lot better than nothing happening. And we know how these suboptimalities in global collective action, you only have to look at the progress of WTO negotiations to see that countries are more than capable of not going for optical solutions. So we had to be mindful of that in this. But in terms of subsequently talking about this, I've been quite surprised at how much this is an emotional issue. How many people will come up to you with very strong views, and I don't mean this in a sort of, to be a sort of disparaging remark, but very strong views without having read anything about the particular area they want to comment about. But we'll be very quick to say, well, it's all baloney. I mean, the science has been shown, it's all nonsense. Everyone knows the science is nonsense. It's actually it's all kind of alarmist stuff. Or, on the other side, you get people that will say kind of, well, you can actually do something about it. There's going to be no cost. It's all about efficiency gains. It's all about free lunches. And actually the world will be a better place. Now, our view on this is, well, it's not impossible that this is overblown, and it's not impossible that doing something about it is free. But if you really take a serious view on the science, what you do find is that there is old science, 19th century science, based on Charles and Boyle's law, which underpinned the theory of this, and empirical evidence that work in the same direction. So this isn't just a question of curve fitting. We're not just saying, look, here's a curve and here's how much carbon's gone up, and don't the two go together? There's a lot of theory behind that. There's a lot of modeling of the damages telling us where we would expect to be in the absence of that. I'm slightly rambling here, so I should try and sort of focus back on in answer to your question. But we do emphasize the fact that the latest, to the best of our knowledge, the science has evolved to such a point, and the understanding of the risks and uncertainties have taken us to such a point that we really would be foolish not to act if we care about these things, and if we do want to guard against some of these more catastrophic events. But there are a lot of people who I just think will not be moved. I'll say one thing actually on that front. It's very interesting to see, and I'm going to use climate change skeptics as an example here, but it's very interesting to see the number of people who started doubting the science and then decided, well, okay, maybe the science is pretty clear, but it's not anthropogenic. And they say, well, it is anthropogenic, but all right, but the point is if you wanted to do something about it, it'd be incredibly costly. And they go, well, all right, maybe it's not so costly, but you're not going to get anything done if China and India don't do something. Now, those are all perfectly intellectually robust views to some extent, but they shouldn't be correlated. They should be independent. And it's very strange, and it's kind of surprising how often the same people that take on one view are very keen to adopt the same view, and you begin to wonder whether there are priors there that I won't go into. But,
Dimitri, we're in California, so we're a little bit flexible on time, so if you don't mind answering the last question.
Yeah.
Okay. So please just be brief to the point.
Okay, thank you. My name is Margaret Torn. I'm with the Energy and Resources Group here and over here, and Lawrence Berkeley Lab. And I have a question about what was at the lower right-hand margin of your graph that went from easy to monetize or easy to quantify to socially contingent and quite uncertain. I'm interested in just hearing some examples of where did you guys end up having to draw that boundary? What little snail that only grew in Cornwall or change in religious beliefs? I don't know, what was that boundary? And did you end up thinking that we should look at these costs and just say, these are the costs plus some intangibles? Or did you end up thinking, here's the cost, and boy, we really need more work to find a way to make them more tangible in this analysis? Just where did you come out? What did you want to highlight about that?
Mm-hmm. Yep.
Robert Rohde, Physics Department. Your analysis looks at the cost of offsetting potential losses. I'm aware of other economic analyses that have looked at the problem differently and have taken a view of, well, if we're going to spend money on something, what's the best way to accomplish good for humanity? You know, things like water development projects, eliminating disease, those sorts of things, and come to a very different conclusion that put climate change far down on the list. I wonder if you could comment on that kind of view and that kind of analysis relative to the work you've done and the conclusions you've reached.
Mm-hmm.
Our last question.
Mm-hmm.
Actually, two brief questions, one that's very practical and one that's more theoretical. One of the assumptions that you made, that you stated, was that China and India had intentions to stabilize or, in fact, diminish their production of greenhouse gases. Not to be too cynical, and I'm not on the side of the people who have those strangely correlated beliefs, but don't you think that that's maybe a little optimistic, considering that they have something like 850 coal-fired plants planned in the next decade? And then, on a totally practical level, where can we get a copy of your wonderful slideshow? Nathaniel Bush, no relation. I'm a grad student here at GSPP.
Okay, well, thanks. Well, maybe I'll start in reverse order. The presentation, as far as I know, we haven't distributed. Now, I don't suppose there's any reason why, bar my rather dyslexic and incoherent speaking notes, we shouldn't distribute it. So probably we can do something about putting that.
We could put it on the center's website.
I suspect I think that probably will be fine. I should check, but.
Yeah.
Coal-fired plants. Yeah, I mean, you're absolutely right. I mean, I'm not in any sense trying to diminish the size of the size of the challenge before us, which is why I think it's a lie to say that this is going to be costless. If you're going to decarbonize India and China, you're going to have to do something that's going to require big diplomatic and political effort, and it's going to require the spending of some resources. We should bear in mind, though, that there are advantages here in terms of the fact that the capital stock in these countries is relatively new and is going to be relatively new. So if you can lock in low carbon intensity capital early on, the gains are potentially very large. You don't have to scrap capital that's already in existence. However, the flip side of that, of course, if we don't, these countries are investing very heavily in their energy production. And we want to make sure that that is efficient. I mean, one of the examples I think that's often given is, and I I hope this is correct, and forgive me if it's wrong, but I have heard somewhere that steel plants in China or car emission standards in China are much cleaner than in the US. Now, for steel plants, that's partly a function of just the fact that they're just newer. I think there are other examples, surprising examples, of where industry in China has lower carbon intensity than in the US, but primarily that's because it's a developing country and it takes on, to some extent, some of the latest, most efficient techniques in production. On the question, the Bjorn Longborg question about the sort of Copenhagen consensus story about there's this array of things you could spend your money on, and if you did a proper analysis of all of them, climate change would come low on the list. I'd have two responses to that. One is that climate change isn't meant to be a substitute, or shouldn't be a substitute, for other forms of development aid or for other forms of development aid, effectively. And I mentioned adaptation, where the two go hand to hand. And I think the EU aid budget is very, very large in that respect. I think it's one of the largest in the world, and it could be larger, and it should incorporate measures to reduce the impacts and also encourage a reduction in greenhouse gas emissions. But I have to say that when you look at these impacts and you look at the possibility of the extreme impacts, 5 degrees or more, with these kind of substantial damages, I find it very difficult to conceive that, and if you did it in a comprehensive way, so you looked at the degree to which these kind of damages would propagate diseases, malaria, HIV/AIDS, political strife, conflict, large chunks of countries such as Bangladesh and big swathes of India having to move big migratory flows, that these impacts don't dwarf some of the other impacts that are mentioned in the Copenhagen consensus. And much of this comes back to this question of the discount rate. The response has to be, yeah, but they're not going to happen for 200 years, and whereas the other damages are happening now. And that's, if you want to weight future generations relatively lowly, compared to generations today, then climate change is not for you. I think it's almost sort of self-evident. This is a long-term issue. And so you will always find all sorts of imperatives today that you need to act upon today that will not get you particularly alarmed in terms of missing the boat for certain stabilization targets, because those stabilization targets are going to have their biggest impact 50, 100, 200 years hence. So that's the only response I can think of to that. On energy, on energy resources, no, I beg your pardon. This is the problem of answering questions in reverse. You have to decipher your own notes. You talked about, I think the question was about how. Yes, I do remember now. It was about this chart here, and how we go about how we manage to define this sort of more speculative and. What fell off the end? What weren't you able to put? What we did include is we tried to include high climate sensitivities, the risks of catastrophe, the whole risk aversion process which we modeled, health impacts, so on and so forth. There were all sorts of things which we had to proxy. I mentioned before that we had to proxy the impact of regional equity weighting. That got us to the 20%. We also, we tackled risk aversity in terms of a known distribution of the risks with given tails using various Monte Carlo scenarios. But we didn't tackle the fact that, in fact, climate change is likely to have what I think is called Knightian uncertainty, where you actually just don't know the distribution at all. I'm tempted to sort of quote sort of Rumsfeldian known knowns and unknown knowns. But it's that kind of world. Our assessment of the risk did presuppose a distribution which we knew about, and clearly there's so much uncertainty that we actually, in some senses, don't know about the distribution, and we would be willing to reduce risks relating to uncertainty on that distribution, and a proper analysis might want to do something about trying to account for that, and that would surely increase the costs further. I partly cop out of this because I didn't work on this aspect, and I'm not sure exactly how we calibrated things like political disruption and migratory flows in these numbers. But I will say this: whoever did it was a brave person, and there would be huge uncertainty in doing it. And that's the point. As you move down here, it's much more uncertain. But you can do one of two things. You can either say, look, I'm going to have a stab anyway and try and account for that uncertainty, or you can ignore it. But if you ignore it, you know that the results will be, the distribution will be tighter, but they'll be more biased. Whereas as you go this way, the uncertainties will be much larger, but at least you'll try and eliminate the bias. And that's the choice that we made. Thank you very much.
Well, on behalf of the Center for Environmental Public Policy and the Berkeley Institute of the Environment, thank you very much for attending this program. And please join me again in thanking Dimitri for his presentation. Thank you.